Canadian telecom sector has seen some volatile trading recently amid fears of a renewed price war in wireless. But how does the health of these companies look from a bond perspective? Joining us now to discuss is Nick Clarke, Associate for Investment Grade Credit Research with TD Asset Management. Nick, great to have you here. We talk a lot about the telecom sector from an equity perspective on the show, not often from a bond perspective. How should we be thinking about things?
Yeah, great to be here. Thanks, Greg, for having me on. I think that the big thing is you can start with maybe a similarity, and that is investors look for these companies for income exposure for their portfolios. So on the equity side, that would be a dividend. On the bond side, that would be a coupon or an interest payment. Now, there are differences, of course, in terms of how you get that exposure, and one of the big ones is the risk to that income changing, right? And with fixed income or with bonds, that's a contractual obligation, where dividends are a little bit more earnings dependent. In terms of the differences, obviously when you look at stocks, typically you're thinking price appreciation. It might be part of the equation here in terms of why I might make an investment. And with bonds, that's normally less so, but we do think in this sector right now, there is potential for bonds to actually increase in value in the next few years. And that's because a lot of these companies have actually taken on a lot of debt and they're starting to pay it down. And all else being equal, as that debt decreases, the value of the bonds that remain outstanding goes up.
Okay, so nice overview of the telecom space in general. Let's dig into some specific names now. We're going to talk about Rogers. It's been working to bring down its debt levels. Yeah,
so Rogers, increased debt levels earlier in the 2020s in its takeover of Shaw Communications. It's had a little bit longer of a time in terms of getting that debt back down. One of the key strategies that they're working on right now is being able to monetize some of their sports assets. We all know about the Blue Jays. They own 100% of the Blue Jays. They own 75% now of the Maple Leafs, of TFC, and some real estate assets as well associated with those teams. What they're trying to do is a two-step process, really, which is to increase the ownership of those teams and those assets to 100%, probably looking at combining them all into kind of one sports entity, and then selling down a minority interest in that to be able to pay down some debt and restore leverage to more sustainable levels.
Let's talk about TELUS. From an equity perspective, people have been, I think, concerned about the stock. I think that's fair to say. It's pulled back quite dramatically since the fall. How does it look from a bond perspective?
Well, that's actually a good context, I think, because with TELUS, the dividend yield is quite high. I believe it's close to double what Rogers and Bell is right now. And the question is, how sustainable is that dividend? And they do have a major leadership change coming up at the company. I believe there's a new CEO starting in July of this summer. So the question, is there going to be, an opportunity for the company or for management to be able to make a change to dividend policy at that point? And I think a lot of investors still are thinking about roughly a year ago when Bell cut their dividend in half or maybe even by a little bit more. So there's definitely some worries about that, but it's a good example of something that would be probably negative for an equity investor, but positive for a bond investor, in the sense that would help the company be able to retain more cash flow and use that to reduce leverage.
Yeah, it'd be interesting to see when Victor Dodig takes the big chair, which he, former CIBC CEO, what happens with that dividend. But a lot of people watching that carefully. Let's talk about those concerns around wireless pricing. I think there were some people in our side of the industry saying, I think the price war has subsided and we can move past this, and now we're afraid of it again.
Yeah, I think that a lot of people were kind of getting cautiously optimistic on what the sector was looking like going into the holiday season in 2025. So think, late November, early December. But, the first quarter of this year hasn't been quite as positive as people, I think, were hoping in terms of price rationality or rational price behavior among the big players. So, what does that mean? I mean, typically Q1 is a low load quarter, as they say, which means that there's not as many subscribers being added to these networks as there are in other parts of the year. I believe if you look back 10 years, it's roughly 10% of the annual net adds that come onto these networks is in the first quarter. So, we have historical precedent to say that maybe there's not a lot of volume being added at these lower advertised prices, but we're going to have to see as earnings kick off next week, really what the impact is going to be on ARPU, which is a metric that the industry looks at in terms of the actual price being paid for these new subscribers.
Average revenue per user, right?
That's right.
Still remember from my old days when I used to cover the telecoms a little more carefully. So we covered a lot of ground here. With all that in mind, what's the potential opportunity right now for investors?
So I think there's maybe three things to keep in mind here. Obviously, what's going on in the Middle East is going to be something that is top of mind for most investors. Is this going to cause some kind of energy-related inflation shock, and will that slow down growth? Everyone's trying to figure that out as that situation remains fluid. So when we look at these companies, in terms of kind of consumer spending, you think about certain things that families might say, let's hold off on that for a little bit. And I think, sitting down with your family at the kitchen table and saying, let's take a few months off internet is probably pretty low on the list. So we look at it from that perspective in terms of being what we call an inelastic business model in terms of the demand for it. So we think that that's attractive against this macro backdrop. And then number two would be, another kind of headline grabber recently that's been top of mind has been what's going on with AI disruption in private credit specifically, and will that be some kind of contagion that will broaden out into the market? And we see the sector as pretty safe from that in terms of AI disruption. If anything, we think that it could benefit from it in the longer term. So we're not too concerned about AI as it pertains to the valuations here. And then number three would just be, I think, the all-in yields. It's really important to recognize they're still quite high, on an absolute basis. And when you compare them to the dividend yields that are being offered, for example, on Rogers or Bell, the bond yields are actually really, close to that level right now. And that's not been the case in the past in some years. So we'll see what happens with TELUS, if that kind of converges as well the way it has for Bell. But I think those three things are quite attractive. And as we look forward here, we have a number of macro events that I think are going to cloud the outlook for investors in the next little while. And we think there's a safety case to be made or a defensive case to be made for exposure to these bonds in this sector.